The private equity landscape is navigating a period of change, with shifting investment strategies and an evolving market environment that are reshaping the competitive landscape. Let's hear from the industry leaders on their take of the stake of the private equity. Please give a warm welcome to our moderator, Juan Delgado-Moreira from Hamilton Lane, and our panelists, Joe Bay from KKR, Rob Lucas from CVC, and Harvey Schwartz from Carlyle. Juan, over to you. Thank you.
Thank you. Good morning, everyone. I think the job is, I'm standing in for an extension of HKMA. My job is to ask tough questions as an investor would look at this, and notice the challenge word on the title, right? Fortunately, thanks to the previous panel, we don't have to cover private credit. So that one's done. But I think it's fair to acknowledge that we have a period of transformation and change in the industry. All of us are meeting clients all the time. The first thing that comes top of mind is for the last 25 years, out of those 22 years, you outperform public equities. Congratulations. Unfortunately, the last 2 or 3, you have not. And so it's easy to get used to 22 years of one trend. What does that mean for the future? But I also want to connect that to a number of new developments in the industry, such as the development of secondaries, continuation vehicles, the explosion of a number of new transactions that are taking more and more space into portfolios and becoming front of mind. So with that as a backdrop, I'd like to go to Harvey first, since he's far out in the corner, and just can I have your perspective to kick us off on this evolution and this journey and your outlook for 2026?
Sure. Well, it's great to be back in Hong Kong. Congratulations to Eddie and the HKMA. What a fantastic event for all of us. A little bit of this has been talked about during the course of the morning. I think it was Ted that talked about the fact that companies are staying private for longer, up to 14 years. If you actually go back to you take a look at the Wilshire 5000, the Wilshire 5000 peaked in the late 90s at 7,500 companies. Today, it's just over 3,000 companies. And there's this massive transformation of public companies, not just delaying becoming, private companies, not just delaying becoming public, but also not becoming public at all. And what's occurred during that period, Juan, as we all know, is the transformative nature of private capital. It was the complete build out from the early days of private equity to private credit, venture capital, and the full suite of capital tools that allowed CFOs, treasurers, CEOs to actually stay private. And it was the most efficient form of capital, in addition to all the public capital they could get, whether they're dealing in the bond market, et cetera. But it really was just about efficient capital allocation. Along the way, there was a proliferation of private equity firms, and there were extraordinary returns. And if you look at the cycle, all that's really happened over the last couple of years is there was a period of congestion where capital was being recycled very, very quickly. But it's gotten a lot of attention. I actually think at this stage, the narrative is a little stale. If you see what's happening in the industry, the private equity ecosystem, if you think about private equity primary and secondary activity, one of our fastest growing businesses, as you know, is really just in the beginning of creating a more dynamic flow of capital for the entire industry. And I think when you step back, the questions we have to ask ourselves against the backdrop of a lot of things that have been discussed today, when you think about what's happening geopolitically around the world and some of the big macro trends that we're just living through a huge shift in, going from a deflationary world to a slightly more inflationary world, global cooperation, steep inflection in technology again, the demand for capital of all forms for the next 5, 10, 15 years in the business that we're in is only growing. And everywhere we go in the world, and it was discussed here earlier today, it's about economic growth and economic competitiveness, and the demand for capital will be very high. So I feel quite optimistic. We've taken 4 companies public in the last year, largest privately owned company in Japan, largest private owned company in India, third largest IPO in the United States. The capital is really starting to return to the industry, but more importantly, the opportunity set going forward, because the capital demand is high and we're not seeing a structural change in how companies get capital and how they optimize capital.
That's great. Harvey, you mentioned liquidity there indirectly and speed of recycling capital. Can I go to Joe now, actually? In how do you answer that question from investors? What's your guidance to liquidity? Another statistic that is quoted, Hamilton Lane data, on a run rate basis, this industry on the PE side was delivering 23% of your prior NAV in liquidity on an annual basis. That wasn't the case last year, last 2 years. I'm sure you get this question. What's your guidance? What's KKR's guidance for that?
Well, I think context matters here. So it's hard to generalize about the entire industry because I think the bifurcation of performance is quite extreme today and probably more bifurcated than it's been in the last 10 years. I'll give you a good example. I think what's happening now is some of the congestion on the exit side. You really have to contextualize really around what happened in 2020 and 2021 and early 2022. The industry underinvested in 2020 in the middle of COVID. Capital markets were shut, a lot of dislocation, and the industry didn't lean in enough to deploy capital in that window. In 2021, with the response by governments around the world, the massive liquidity that was injected, interest rates going to unreasonably low levels at that point in time, there was a rush of deal making at high prices when there's a lot of liquidity in the marketplace. And if you think about our private equity business, we're holding companies for 4, 5, 6, 7 years, right? Those deals that were done in 2021 at the peak, if you will, at high valuations with a very aggressive amount of leverage because interest rates are so low, those are the deals that are stuck today in the industry. But again, I think what you're going to see, like the firms that are doing well in this environment are the firms that were very disciplined, I think, in terms of pacing of investment in that time frame 4 or 5 years ago. Our deployment in 2020 went up 40% in the middle of the dislocation versus 2019. And our deployment was flat in 2021. Right, so if you look at our US private equity business in the last 5 years, for every dollar we've invested, we've returned $2 of capital to our investors. This year is going to be our big year for Asia liquidity, given the stock markets in this part of the world. Half of our global distributions in private equity are going to come out of Asia, which really speaks to the capital market development in this part of the world you're seeing. So I think a lot of what you're seeing, the context really explains a lot. One of my partners recently did an interview, and she said, how is it that there are more private equity funds in North America than there are McDonald's franchises? Right, and it's true. 14,000 McDonald's locations in the US, and more than that in terms of private equity funds in the US. So it's hard to generalize. I think you have to really look under the cover and see how people have invested. And I think today people also talk about the slowdown in deal making and activity. I think people are resetting and trying to get back to basics. Valuations are objectively high today, right? People should be more cautious in deploying capital in this type of valuation environment. And there's no shortage of financing, whether it's public financing or private credit financing, right? And I think you have to be very disciplined in a market like this and focus on what private equity is meant to do, which is fundamental operational value creation in companies, bring better governance to the table, and I think that's how you're going to generate consistently and outperform the public markets.
Thank you. Rob, to you, Joe connects cycle, deployment pace, vintage. From a European vantage point, do you see any difference in terms of the point in the cycle, the level of exits, and the outlook?
Yeah, thank you, Juan, and thank you, Eddie, for having us back. It's great to be here. I think it's a very exciting time at the moment, I've got to say. I think it's very hard, as Joe's just been mentioning there, to underestimate what we've been through over the last 5 or 6 years as a global economy. It's very easy to forget that come sort of February, March of this year, it'll be 6 years since COVID hit us. All the destabilization, all the volatility since, geopolitical, economic, and actually the resilience of the global economy, but the resilience of the world in which we're in, the alternatives, I think has been pretty astounding in actual fact. I totally agree with Joe that we're seeing a real bifurcation in the industry. I mean, it's always been there, but of course, the more players you have, the greater the levels of volatility within the market, the more that shows through. So just taking your point about the European outlook, we are seeing strong flows into Europe. And Europe's always been a very interesting and successful place for private equity investing and alternate investing. I mean, by way of returns over the last decade, I think it might take quite a lot of people by surprise that the net IRRs in Europe over the last decade have been higher than they have in the US. 16% net IRR over the last decade in Europe versus 15 in the US. But it's even more interesting, and the key to investing in Europe, when you look beneath those figures, when you look at the amount of alpha, and alpha's been talked about a lot this morning, and I'm sure will be further. It's very, very important within our world. And if we look at what Europe has managed to produce, within Europe, half of that 16% is alpha. In the US, there have been, we know, very strong tailwinds to the US market. But that has actually meant that the levels of alpha have been 1.5% as opposed to 8%. Now, why is that? Well, the US market is a very active, very liquid market, but it's also a very efficient market. Europe is a fascinating place to invest because of all the challenges and the imperfections that the European market has. And that means that if you have players like KKR, like Carlyle, like ourselves on the ground in those local markets, the ability to produce high alpha, the ability to produce strong returns in that market is very strong. And that is what's really recognized by the most sophisticated LPs and institutional investors out there.
Just to, before I let you go on liquidity, all of you, secondaries was mentioned as well. It's front of mind. Harvey mentioned one of our fastest growing areas. The LP angle here is, are they really exits? One of the issues against Europe was that a big percentage, as much as 40-50%, were actually secondary transactions, not IPOs as much as. Can I get a quick reaction on that? And maybe you might be wanting, Joe, to grow your secondaries business. So, Harvey, can I give a quick reaction of how you think of secondaries? It's a continuation vehicle, a true exit, yes or no?
Sure. So I think one of the things I find quite fascinating is narratives can be quite stale. I think one of the stale narratives is that there's not an opportunity in private equity because exits were slow for a couple of years, and I think my panelist partners here have covered it quite well in terms of the dynamic in the industry and what's happening. What I also find quite fascinating is that secondaries has been growing quite quickly over the last couple of years as a liquidity solution. But the industry should be evolving with liquidity solutions. I actually think this is a trend that's in the very early days, and I actually think it's quite good for the industry because I think the availability of more exits, more efficient capital allocation is only a positive. And so as one of the fastest growing parts of our business, I think that's a sustainable trend because I think the industry sector will continue to grow. We may see consolidation. I don't know. That was the first time I knew there were more private equity firms than McDonald's. I thought it was quite fascinating myself. But I think there'll be a tail of consolidation. There will always be specialist funds, just like there's 4,000 banks or whatever the number is in the United States, but we think of them as the people that were on the stage earlier. And so I just think that this is an early phase of evolution of the asset class where however you monetize, as long as you're monetizing with the types of returns we're talking about, then I think it's actually more proof of concept versus test of concept.
Yeah, no, that's great. Joe, then connecting, you said earlier 50% of your exit activity was in Asia. Can we go back to Asia? You've obviously built the business here, so you're front and center and it's close and dear to your heart. But how do you think of investing in Asia? How is that statistic? Can you unpack that a bit for the audience?
Sure. Love being back in Hong Kong. I spent 10 years living out here from 05 to 15, building out our business initially. So we've been investing in this part of the world for a little over 20 years now. And I would say at KKR, Asia is by far, at least in private equity, our fastest growing business. And the one where we see the most, I think, unique opportunities in this environment today. And I think that's underpinned by a number of just fundamental trends and tailwinds in Asia. There's been a lot of talk about Korea, Japan, and the real opportunities on the back of corporate governance reform. It's no surprise that the Tokyo stock market and the Korean stock market have gone up dramatically since these reforms were implemented. It's just hard to get deals done, right? But you have large conglomerate structures. You have now CEOs and boards focused on ROE. So they're selling non-core businesses, they're selling non-core assets. And we're starting to finally see a pipeline of large-scale divestitures out of companies. For us at KKR and Global PE, outside of the United States, the largest destination of private equity capital today, after the US, is Japan. And India is probably top 4 markets as well. So Asia is a huge part of what we do. We have 9 offices in the region, around 650 people on the ground, very localized, and around $80 billion of investments in the ground today. So it's that, it's corporate governance and buyouts, corporate carve-outs. It's clearly the tailwinds around domestic consumption in these key markets. 3 billion consumers, Asia's 60 to 65% of global GDP growth. As that middle class keeps growing, basic things in consumption, value-added services, healthcare, they're all going to be really exciting areas to invest over time. On technology trends, there's been a lot of talk about AI. I think that's really more of a China opportunity in many ways because, Korea, Japan have great technology, but they're short on energy, and you need both. And they're short on land, right? So China, I think, is going to be the real dominant challenger to the US in AI because they have that combination of assets to really scale AI quite dramatically. But in Korea and Japan, I think there's as big an opportunity, though, given their demographics, the aging population. They are really big leaders in robotics and industrial automation. And I think that's going to be probably the next 5 years, the bigger opportunity for Korea, Japan, than just pure AI applications. And then I'd say the final thing is really around intra-Asia economic integration. Like, that's a big deal, right? Asia is trading more with Asia. China, Japan, Korea, India, Southeast Asia. Intra-Asia trade is just a little over 60% of trade within Asia. That number's probably going to 75%. So when you think about where to invest in this part of the world, betting on the region, I think, is a pretty safe bet long term.
Great. We're down to the last 5 minutes, so I'll ask the members of the panel for quicker answers on the following rounds. But Rob, Harvey mentioned, and you mentioned, Joe mentioned, the more GPs than McDonald's. A fellow European, Per Franzen from EQT, said 5,000 fund managers and GPs would disappear in the last few years. Really? What's your take on that? What form could consolidation take? You acquire one firm in secondary space. What's your take from a European perspective of consolidation, and what would be CVC's approach to it?
Sure. Well, let me just go back 40 years to my first day in the office, Juan, at 3i, when I started my career in private equity. Hadn't been invented, so it was venture capital back in those days. And I arrive in the office, and the first thing I'm greeted with is, welcome to 3i, welcome to venture capital. You've just got your timing completely wrong, and the industry's dead. And the reason I recount that tale is because, of course, it was wrong, but also over the years we've heard a lot of times, I'm sure we've all heard, that the industry is finished in its current form. And the reason I make that point is because we should never underestimate how adaptable private equity and the alternates market is generally. And that's what's happening at the moment. We are adapting to a very different world. And it's the ability to adapt so rapidly that is such a powerful part of the industry. And so, yes, to your consolidation point, there will be consolidation. And I think consolidation, as Harvey mentioned earlier on, there are going to be winners and losers within this world that we're going through at the moment, the amount of change that's going on. And the bifurcation that we're seeing, it'll all be down to performance. It's always been down to performance. And those firms, I mean, we're all fortunate to be in the situation where performance is very strong. But there are a lot of players out there where performance is less strong. And the LP community is a very discerning and very sophisticated community. And their capital will follow that success. And the stronger will, where they can really bring onto their platforms important and additional aspects, that consolidation will occur. So we acquired our secondaries business We acquired our infrastructure business, and should the opportunities arise further, no doubt that we will acquire more. But it's also very, very important to say within that it's about culture, it's about scalability, it's about finding real quality so that we can build the businesses going forward. But I'm sure that's going to be part of it. But equally, as Harvey said, there'll be new businesses generating themselves within our environment. And so the environment is just very dynamic. And so I don't see consolidation as being in any way a negative aspect. I think it's a sign of strength.
Connecting, if I may, consolidation with the conversions, also linking it to the previous panel. Harvey, you started us off, closed us off on public and private hybrids. We can ask Joe, how's it going? Because you have one. But are you two looking at?
Well, just to emphasize what Rob said before, I was on a trading floor in 1998 when long-term capital went out of business, and a very senior person was standing behind me. I was just a kid and said, "That's it. The hedge fund industry is over." The hedge fund industry sequentially has grown for almost 30 years since then. So I think to Rob's point, calling the inflection point in any industry, banking, public markets, ETFs, public bonds, these are all very, very valuable tools for capital allocation. In terms of the earlier panel discussion, and I want to leave some time for Joe, I think this is, again, not revolutionary. All of us have worked as fiduciaries for municipal workers, firemen, people in the United States for pension plans, and wealth has been a big part of this industry for a long time. It was one conventional vehicle or a wrapper. So again, I don't think this is revolutionary what's happening. This is just about asset allocation. And I could agree with both Manny in the last panel and with John about the debate around where you're going to get a better return. I think ultimately it's how people think about their own portfolio construction. But this is, again, completely evolutionary. I don't even think of this as particularly creative corporate finance. I think this is just about solving a client problem globally, whether it's wealth, mass affluent, or in the retirement channel where we've been providing these services for a long time.
Rob, may I rudely skip you and give Joe the last 20 seconds? How's it going?
It's going great. I mean, we have an amazing partner in capital, and you heard from Mike Gitlin earlier this morning. So it's the early stages of this partnership, and I think as people have said this morning, this is really about giving individual investors more choice, fundamentally, right? So if you're a doctor or a dentist in the United States, historically, you don't have a big pension plan, so you don't have access to the alts. Really what these products are fundamentally doing is democratizing access to the alternative space and giving individuals just that much more choice. So it's going to take time. This is not going to be a silver bullet, but I think in the next 10, 20, 30 years, you're going to see that wealth channel be a major part of the alts industry.
That's great. And that's a wrap. Thank you so much to the panelists and the leaders. Thank you.
Thank you very much, our speakers.